this thing started. So we'll open the door and get some folks in the door. So that's good. And see how we're doing there. Cool. We got some folks coming in. Open the door a couple minutes early. And this is good. This is good. I'm excited. So yeah, this is going to be a fun one. So very nice. Very nice. Tony, we'll get Christine's information up there too, I would assume. She's so good at that. So good deal. Nice, bright, sunny, chilly Saturday morning. All right. Let everybody get in. Chris, the lighting's good over there. You're good. So let's see here. All right, good. Got a few folks in. We'll got about a minute away. I'm going to start chit-chatting about this a little bit. This is really kind of a long time coming. So I've been wanting to do this class for a long time. And ultimately, you know, I'll be honest with you. One of the reasons this class is here and gets done is because of Tony, who is with us here on the panel. It's been in my head for a long time, and we put it to paper, and Tony, like many other things that she's been able to do for our team, she made it happen. So I definitely want to give her a big shout out for helping this become a reality. So in this class, as it is, as we go through it, you guys will see that there is a slide where we talk about brand new homeowners, and I have some brand new homeowners. When I say brand new, I'm talking they bought and closed on their house in January. So we are going to do this class every month specifically for our brand new homeowners. Now, even if you're not a brand new homeowner, there's a lot of value in this class. So there's one slide in here where we're going to cover a couple of things in here, but the rest of this is going to be geared for everybody, providing you own a home. Now, ideally, if you do not own a home, then this class is probably not for you. But I have great news. A week from today, same time, same channel, different Zoom link, we're going to do a home buying class on Saturday for anybody that is thinking about buying a house. So that'll be 9 to 10, our home buying class on the, as I glance at my calendar, on the 12th. If you're already in a home, you are in the right place. So we're going to get started because it's a little after 9 o'clock. We've got some people logged in, and I like starting on time. So first and foremost, I want to introduce, when we do these classes, we are going to have a financial advisor. I am not a financial advisor. I am not authorized to give you financial advice. However, being in this business for 30 years and seeing financials and also being coached and mentored by somebody for the last 10 years who's worth tens of millions of dollars, we have learned a lot, and we want to pass that on to you guys. Ultimately, our mission statement, and this really fits with our mission statement, is to make the lives of our customers, our employees, and our business partners better by being with us. And a lot of things that we talk about here today with you, I have worked with my staff very hard on. We've done budgeting with them. We've actually encouraged them to do savings and different things like that. So for today, we have our guest panelist is Christine Burbidge, and I always want to say Bridge. I don't know why, but it's Burbidge.
That's normal.
I know. I caught
I've been
myself
dealing with that all my life, so people just throw an extra R in just cause.
Yeah, I don't know. I don't know why that is, but Christine has been in the financial planning world for 17 years. Her motto is that helping you. Oh, sorry. Suri's talking to me for some reason. Sorry about that. Her model is helping you build your wealth so you can live your dreams. And that kind of fits along with our philosophy of making your life better. Ultimately, Christine and I have talked, and she has very similar understandings of what we think good investments are, bad investments are, and our philosophies kind of aligned. So that's why we invited her today. Christine, I'll let you add anything that you want before we get started.
I don't know that I could have said that any better myself. So I am always open for questions. So whether you become a client or not, I am here to answer your questions. I feel like financial knowledge is not something we're born with, and a lot of people need to learn it and we don't teach it in schools. So there's no such thing as a dumb question. So feel free to ask anything that you like, and I will answer to the best of my knowledge.
That's awesome. And I agree as well. There is really no such thing as a dumb question. As you guys have figured out from the format, you won't be seen here. So your questions will end up going into the chat as we go through this, and you have questions, please enter them into the chat. Hello, Robin. Good morning. And throw those questions in the chat. And now we're off. I do need to move this. My chat screen is covering my screen. There we go. All right, good. So if you want to be better financially fit, you are in the right place. So we're going to go through what I believe is the most important steps into creating financial wellness. A lot of this comes from not only the coaching and mentoring, but also books that I've read. There's awesome books out there, such as The Latte Factor, Automatic Millionaire. Both those books are written by David Bach. There's another book out there called The Richest Man in Babylon. Great books if you want to understand some of the concepts we're about to talk about. So first of all, in order to figure out where you're going, you have to determine where you're at today. So whether you're living check to check, maybe got a little bit of savings, or on your way, we know this class is going to help you get there quicker. So, and the question, of course, is where do you want to be? So obviously we all want to be financially free and independent, but what does that really mean to you? You should take a second and figure that out, because for some people, it might mean golfing all the time. For other people, I have a mentor that he's religious, and he feels that, there's nothing in the Bible about retirement. So, he's probably going to work until he's not physically able to work. But he has the freedom to work or not work. And that's what's important to him. So figure out what's important to you and what that end is going to be, whether it's being on a golf course, fishing, or maybe giving time to charity. Maybe you're still working, but you're actually giving back to something that you really love and believe in. So we know that we can show you how to get there quicker if you have a plan. So we're going to go into, again, I mentioned this is for homeowners, and we've got a slide here that we're going to cover that's for our new homeowners. So this is the only slide that will cover that. Everything else will be for everybody else that's already in a home. So if you closed last month, couple different things. Where I get the question I get most often is, where do I send my mortgage payments? And the question, okay, good. We got some questions coming in. I'm going to cover this slide and then we'll get into those questions. So where do I send my payments? There is a piece of paper that was part of your closing documents that usually tells you where you send your first payment. That will be followed up by mail within 2 to 3 weeks of your closing, where you get an introductory letter to whoever it is you're servicing your loan. It may be CrossCountry, may not be CrossCountry. Either way, you can reach out to me if you have any questions. I always get the next question that I get is, can I set up automatic withdrawal? Yes, as a matter of fact, the lenders love you to set up automatic withdrawal. They don't like paying people to open up envelopes. So obviously they will let you do that. Most of the letters that you'll get for your first payment will give you a website or a toll-free number so that you can go and set that up between the lender and your bank, wherever you want the money to come from. Also, insurance notification. There's been this change over the last couple of years where there is a tremendous amount of mail that gets sent to new homeowners in the first 90 days. All of it looks like it's coming from me. None of it's coming from me. Well, most of that, I would say 99% of it is not coming from us. The problem is you're not going to know unless you open it up. First of all, why is that coming to you? Your recorded mortgage is a matter of public record. So once there are marketing companies out there that harvest that data and then sell it out, in which you're going to get, I know we've all gotten the phone call about extending our car warranty on cars we don't own. You are going to get as much mail asking you to get insurance. And they're not talking about homeowners insurance, although I think you'll get some of that. They're really trying to sell you like whole life and different types of insurance. We're going to cover insurance here, but I'm going to highly recommend that you don't engage with any of those people. Open up the email, go to the fine print, because usually the first sentence in the fine print is, we are not associated with CrossCountry Mortgage. we're Cambridge Financial or ABC Insurance or whatever it is. Once you see we are not affiliated with CrossCountry Mortgage, shred that stuff, get rid of it. There's even a company out there now, and I know this because my brother and sister-in-law just bought a house and they were sharing all this garbage that they were getting. There's a company out there now that for $50 will give you a copy of your recorded deed. You don't need to pay them $50. You can go to the county and get it yourself. But I thought that was a interesting little money play. So any questions you get about mail that you get after the closing, if it's confusing, feel free to reach back out to me and we'll sort it out with you. Go through it. Most of it's trash. I apologize, but because your mortgage is a matter of public record, there's nothing I can do about it. So, but at least now you know. All right. So speaking of insurance, so your home is insured. Oh, I do have questions. So hold on. We got, how do you pay down interest on your mortgage sooner rather than sooner? Okay. Robin, we're going to get to that. That's a great question. So Robin asked, how can you pay down the interest of a mortgage sooner rather than on time? So we'll talk about that as we get a little bit deeper into that. I want to address that. So thank you. A little water. All right. So your home's insured. I know it's insured because we wouldn't let you close unless you had proper homeowners insurance. But is it protected? And what do I mean by that? I mean, what happens to that home if something happens to you? So I strongly recommend that all my new homeowners think about getting a will. Now, why would we need a will? A lot of reasons that you need a will. First of all, let's say you bought the house with a significant other and you're in joint tenancy. Certainly if something happens to you, your ownership in the house slides to the other person that's there. But God forbid something happens to both of you and you don't have a will, well, the state of Illinois is now responsible for sorting out where your property goes. I don't know about you guys, but I don't think they handle their own money really well. I certainly don't want them to have a hand in handling our money. Also, a couple different examples. I've had situations where customers, and this is fairly horrific, unfortunately common, couple buys a home, one individual's on the title, the other individual is not. Maybe this is a second or third relationship for them. The person on title, something happens to them. It was always their intent that they both remain in the home until they both pass. But the person on title, something's happened to them, and now their family has swooped in and they've decided they're going to sell the home and kick the other person out because they want the money, and frankly don't like that person because it wasn't as good as the original, person that was there, or the mom or dad or whatever. The point of the matter is, if you have a will, you can settle all of that. Not only that, but you take the stress off of your family who may end up fighting or trying to figure out what's going to go on. Have a will. Make sure that whatever your direction is clearly defined. It's not that expensive. We put it here in the slide. We polled a bunch of attorneys, $150 to $550 just to create a simple will. Christine, do you have anything else to add to that, or any other stories that you'd want to opine?
Oh, you don't want to hear my stories, but what I do highly recommend that you do get a will. In fact, I will give a personal story. My husband was diagnosed with cancer and I went, oh snap, I need a will. I called an attorney friend of mine and the next day he had it over to me. The will is what the courts use to define where your assets will go in the case of your demise. So you do want to make sure that that is all up to date. You want to make sure that all of your accounts, even if you have savings accounts, bank accounts, that those are all up to date as well, with whatever your intentions are for the money and where it's going to go in the case of your demise. You're going to talk about insurance soon, right?
Yeah, that's coming up next.
Okay, so I won't get into that.
So the last part about the will, where do you go get a will? I would say probably where you would go get the will is start with your real estate attorney. If you liked how they handled your closing, then go back to them. Most real estate attorneys are in family law and they can create the will. If you did not enjoy your experience with your real estate attorney, then come to your friendly mortgage professional and we'll get you a referral for somebody. So, but I would have a will. It's a great investment once you buy your house. Now, next, simple term insurance. I mentioned that you're going to get a lot of mail about insurance. A lot of this mail, they're trying to sell you whole life, universal insurance. Christine will put you on the spot. What's the difference between whole life, universal, or simple term insurance?
Okay, so term insurance is like renting an apartment. You own it for a certain period of time, and then when you move out, you're done. A whole life or a universal life or a variable universal life are a permanent insurance, wherein there's no term associated with that. So you will own them for the rest of your life, and your beneficiaries will receive that money in the case of your demise. Is that simple enough?
Yeah, that's simple enough. And what we find is that ladder insurance that we talk about, it's very expensive. It's not as cheap as term insurance. And we're really just talking about trying to protect the asset that you bought and the people that are around you that may survive you. And we're going to talk about a little bit more in a second. But a lot of people stay away from insurance because, like, oh, I don't want to think about my death. I got bad news for you. We're all going to die. It's not, it just is what it is. So we don't even know when. So the fact of the matter is, you really want, if you have insurance, you're better to off protecting the people you love. So, and it's really, really cheap. So I am going to tell a story relative to an insurance situation. Successful young realtor, married, 3 kids, his wife, homemaker, no job, buy the dream home for $450, wonderful home. 3 months after they close, he perishes in a motor vehicle accident. No life insurance. She's a homemaker with 3 kids in a $500,000 house. Guys, this is how that ends. They now move out of that $500,000 house into what? Who knows? But I guarantee you, when they closed, that was the happiest day of their life. And I guarantee you, he would have wanted them to stay in that house. And honestly, he was in his 30s. So having insurance to take care of them would have been extremely cheap. So here's how cheap it would have been. This is just a sample chart that we took as far as it's concerned. So first of all, term. Ideally, if you're young, you want to get it as long as possible because it's cheaper now than it is later. And it doesn't mean you're married to the insurance for 20 years. It just means they guarantee that premium to you for the next 20 years. So if you're in your 30s and you get a 30-year policy, you want to maybe get insurance enough till you get hit retirement age, just to protect you while you're working. How much? Well, how much really? And Christine, I'll reach back to you for this, but in a situation where, let's say, most people are double income households. So if the spouse that you're thinking about insuring is making $50,000, that's usually net take home about $35,000. And we want to make sure, let's say our kids are between 8 and 10. So we want to make sure we stay in the house long enough for the kids to graduate high school. Do we need to replace $35,000 net over 10 years? That sounds like a $350,000 policy. I would take a little more because of that I word that we're all hearing about, inflation. So if you took a $500,000 policy, you could easily replace that income over the next 10 years. Now, Christine, do you have a better formula, by the way?
Yes, well, not better, but kind of somewhat the same. We do what's called a life analysis. So it's your liabilities. So say you have a bunch of credit card debt or your mortgage, whatever it happens to be, car loans, that kind of thing. We take your liabilities, your income. So what income are we going to replace and for what period of time? So are you going to replace that 35,000 for 20 years or 10 years? What does that look like? Your final expenses, unfortunately, you do have to take care of the body once it's gone. And that can be expensive, and whether you bury, cremate, whatever.
Sure.
Those are you have a big party. I don't know, maybe it's a good thing.
Celebration of life.
Right. So anyways, and then, anyway, so we calculate all those numbers and then figure out what policy, what the need is, and then there's the affordability. So I don't like to sell somebody a policy that they can't afford, because it's not going to go well, because if you stop paying the premiums, then you're not insured anymore. So
Right.
anyways, so that's how essentially how we work it out.
Yeah, I mean, and that's it. That's a deeper dive. I mean, we've kind of kept it a little bit simple here because honestly, these are simple. We called it simple term insurance for a reason. This is
Right.
just some simple math that you should be able to put together. And guys, at a $500,000 policy at the age of 40 is less than $30 a month. That's pretty affordable insurance. I mean, even if you just wanted to pay off the mortgage and you leave the surviving spouse with just taking care of the taxes and insurance because their income will handle it. Think about what you'll need and then go get some insurance so you don't end up like my friend, the realtor, who I'm sure that's not how he wanted his family to go forward. So,
Right.
all right. And do we have any questions? Oh, and as far as where to go for your simple term insurance, and if we have any questions, and Robin, I promise I'll get to your question. But if we have any questions, let me know. And maybe I'll just do a little quick poll. Does everybody have insurance out there? Maybe throw something in there. Yes, that you've got some insurance. Your employer probably provides you a little bit of insurance, but trust me, it's not enough to take care of most things. So it's probably enough to bury people. So.
And Rich, I would add that if you're employed, and you leave your employer, guess what? A lot of times that insurance does not come with you when you leave that employer. So if you get laid off or if you leave your job and go somewhere else, yeah, you might have it at the new place, but I would argue that you want to take a look at having something that you own that somebody else doesn't own. So in case of a tragedy or whatever, you still have coverage.
Yeah, perfect. So where do you go for the insurance? Certainly your homeowner's insurance agent probably sells term insurance. It would be very unusual that they don't, but you certainly can go there. If you want to go to a financial advisor that might be able to help you figure out how much term insurance to get, somebody like Christine would be perfect for that. You can certainly reach out to us. I've had term insurance for a very, very long time. Be glad to share with you some of the people I've got insured with, and we can get that over to you. And I see most folks actually say they have it. Some people say they'd like to reinvestigate. I know there was a couple things, and maybe you could speak to this, Robin. My agent came to me it was kind of weird. He came to me like in the fall and he said, by the way, there's an insurance. Actually, I had more than one agent come to me with this. There's an insurance product out there, life insurance product out there where they're insuring up to $500,000 or $1 million, like without any medical testing or anything, some sort of special. I had a couple people talk to me about that. Did you hear anything about that? Christine, did I lose you?
Oh, sorry.
Oh, there you go.
No, I have not. And I would argue that that's probably some kind of scam.
Okay. All right.
Because I mean, yes, if you're 30, maybe $500,000 they'll do without medical. In my world, no. I just had somebody got $100,000 policy and she did not have to go through medical, but it's rare that you don't, especially with that kind of money. Maybe
Sure.
if it's 100, maybe they'll waive it, but not $500,000. I can almost guarantee that.
Yeah. Okay. Well, I had heard some things about that. So certainly pre-existing conditions and things like that, even if they don't do, like in Christine's example, even if they don't do an exam, they're certainly going to reach back out to your doctor and pursue those records just to see what's going on with you, whatever's on public record. I just thought it was
I would argue that, when you go through this, it's kind of like a free little mini medical exam. You pee in a cup, they take a little blood, they might do an EKG. So you find out you're healthy and it doesn't cost you anything. So there's no harm, no foul.
That's true. That's true. All right. So we are big fans. We're going to move to the next section of this. We've already taken care of the house. We got the will, we got the insurance. Now we got to take care of ourselves financially, and we got to pay ourselves first. A lot of those books that I refer to, the Latte Factor, the Automatic Millionaire, they refer to paying yourself first. I mean, you're the most important person. You should be working for you. One of the books that I read talked about the fact that the IRS, 60 years ago, maybe, used to actually not take their taxes out of your check. They used to just wait and have you pay it. And the problem is people didn't save the money to pay the IRS. And so they figured out, I think it was in the 50s, they figured out, hey, we need to take the money first. So there was a time when you got your check, but you were responsible for your own taxes, almost like being self-employed. Now, they got involved, they take the money first, but it's a very important lesson. They took their money first. You should pay yourself first. So that way they guarantee they got their money. Why not guarantee you pay yourself first? There's a lot of apps out there where you could actually take a little bit of money every month and send it to wherever you're going to save it. Automatic deduction that comes out every month. So in an example here, if you're making $18 an hour and you pay yourself, that first hour a day is your money, and the other 7 hours you take care of your bills and taxes and all that other stuff. Even at $18 a day, you'd save almost $5,000. Now, that assumes, by the way, wherever you saved it doesn't have any interest or doesn't return any rate of return. That's just 0%. You're still going to save $5,000. We talked about eliminating credit card debt. We are going to talk about that, and then we're going to get to Robin's question relative to paying down your mortgage. I think that we can pay down your mortgage, but we need to do a few things first. First things first, get rid of credit card debt and build an emergency fund. So, and I do believe I'm an advocate of doing both at the same time. And people are like, what are you talking about, Rich? If all you do is concentrate all your funds on paying down your credit cards, the minute poop hits the fan and life happens and you need a new set of tires or a furnace or something like that, the credit card debt's getting built back up. So if at the end of the month, you have $200 left over, $100 goes to the credit cards, extra payment, the other $100 goes to your emergency fund. Now, an emergency fund at minimum should be 3 months, whatever your survival number is. How do we figure out a survival number? We're going to talk about that. But your survival number is the minimum payments on everything you have to pay. The minimum credit card payment, the minimum house payment, the homeowners association, if you have that, groceries, gas, and all that. We're going to show you how to figure that out. We did a budgeting class last month. In the budgeting class, we showed how to use a budgeting form. By the way, the budgeting form wasn't about slapping your hand if you spent too much. It's more about seeing where your money's coming in from, what you're paying, and the most important thing is tracking your saving. It was a great class. If you want a recorded copy of that class, reach out to me. We'll not only get you the recorded class that we did last month, but we'll also get you the form that we use for budgeting. And it's critical if you're going to follow along with some of the things that we're talking about here, if you're not already doing your own budgeting. So the survival fund should be a minimum of 3 months. I would say it could be longer, but the only reason it could be longer would be based on you. What do I mean by that? If you're in a job where the average time to get hired is longer than 3 months, then you're going to want a longer emergency fund. Let's say you're in some sort of specialty type of field where there's only a handful of companies that would even hire you for what you do. It might take you longer to get a job. You may want a longer emergency fund. If you're in a job where you can get hired the next day and people are constantly recruiting you, blah, 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 3 months should be enough. So, and eventually we're going to talk about setting up a 401k, but first, the survival number. How do we figure out what our survival number is? We use this form called the personal family budget. And at the end of the day, when all these numbers are added, by the way, our form automatically calculates not only this number down here, it adds it all up, but it drives that number into, oh, you can't see it, it's really small. Anyway, it drives that number into what should be 3 months of so if your survival number, actually we'll show it on the next slide. Here we go. This is a sample budget that we did in the class. So in this particular person's situation, their survival number is 3651. It calculated out that they should have $10,953 in an emergency fund somewhere. At the time that they did this, they only had $3,900. It's not a bad thing. You shouldn't punish yourself, but you know what? This person now is aware of what they need to do. Don't punish yourself. Don't beat yourself out about it. The fact of the matter is, because you're using this form and you're doing something about it, you should be proud of yourself, because candidly, not everybody knows this stuff, and most people don't care, and they live paycheck to paycheck, and it's really no way to be financially independent down the road. So this will again calculate your survival number. In this little situation that we had here, we showed that they actually had about $280 left over, and that ended up getting added. They had, by the way, paid off their credit card. We showed that up here on the top. Hopefully you guys, hopefully you guys could see that. They paid off their credit card. They still had money left over. That money went into the money market. So again, we got a really good budgeting class. If you're interested in that, reach out. Tony put her email in the chat. So just if you guys will let me know how many people are interested in that, I'm just curious. In the meantime, we're going to roll to the next slide. Okay. Before we get into the 401k, let's assume that we've got our credit cards in order. We've got our emergency fund on our way. The very next thing that we want to work on is a 401k. Christine, what's a 401k?
So a 401k is set up by your employer. Not all employers have them, and if you're a small business, you can set up one on your own, and I'm getting way deep into the weeds. Sorry about that.
Okay.
So a 401k is a retirement plan that your employer sets up. And generally they say, if you contribute 5%, we're going to match 50% of that, or whatever it is. It is a way for you to save money and put money away for retirement without ever seeing it, because it comes directly out of your paycheck. You don't have a chance to go to Starbucks and spend it. It gets deducted and it gets put into an account where it is going to get invested and then grow on your behalf. So once you get to be 65 or whatever age you retire, you can take that money and use it towards your retirement.
There you go. That's excellent. Thank you. So here's the thing. If you want to be the smartest person in the planet with money, you need to be in a 401k. Guys, I'm an advocate. I work on all my employees and strongly encourage them to get involved. Some of my most stubborn employees fought me for years, got in. A couple years later, they said, this is amazing. I can't thank you enough. Let's talk about some of the simple advantages. So first of all, you should start small. Most people are like, ugh, I can't afford it, blah, blah, blah. Couple of things you need to know. You could start small. You could put 1%, 2%, 3% of your income. You pick the number and you can change the number at your own will when you want. But I would start small, because some people, if you start with 2%, you might notice it a check or two. And then after the first couple of checks, you're not going to notice. And honestly, once you stop noticing, I might increase it a little bit more. But let's talk about the money coming out. Let's say that you took, I'm going to just use very simple math. Let's say you took $10 a paycheck out. It's nothing, $10 a paycheck. Let's say you're in the 29% tax bracket. Well, that $10 you're not paying any taxes on, it's going directly into your retirement account. So if you're in the 29% tax bracket, you literally just made $2.90 on the $10 because you didn't pay it into the government, and that's Fed and state. So you didn't pay any of those taxes. So you're already $2.90 ahead. But let's say your employer, like CrossCountry, we match 50% of the first 6% that goes in. So on that $10, they're going to give you $5 right out of the gate. So you made 50%, you saved 29%. Literally before that money gets into the stock market, you're up $7.90. That's, again, you want to be the smartest person on the block with money. Christine, besides crypto, where else can I get a 79% return?
I'm not sure that I would put a lot of faith in crypto either. So nowhere is the simple answer.
Meme stock, I can't get, whether it's AMC or GameStop or crypto, I'm not getting 79 cents on my money. Guys, invest in the 401k. And by the way, the one thing I didn't talk about, and I did not talk about it because the stock market's down right now, but the stock market will also give you a return on your money. So I want to jump a slide here. Here's the stock market performance over the last 30 years. Stock market performance, $5,000 invested 30 years ago today is worth 30,000. Now, market's going through a correction right now. People are like, Rich, the market's correcting. Don't you see what's going on? Sure.
Yeah. It's a
The
good time to
market
get in.
well, exactly. I mean, the funny thing is that means things are on sale. And if you're contributing to your 401k every month, you're doing something called dollar cost averaging. So you're buying when the market's up, you're buying when the market's down. The bottom line is over the last, just the S&P 500. Chris, tell everybody what the S&P 500 stands for, what it is.
So it's the Standard & Poor's, it's 500 stocks that make up an index, okay? So
Wait.
when you-
It's, I just want to clarify something. It's the stocks are actually, the stocks represent 500 publicly traded companies. So
Correct.
500 companies in the stocks of those companies. Go ahead.
Correct. So so the S&P is a word you hear all the time, or a phrase that you hear all the time, and what the S&P 500 is doing. And it is considered an index that is a barometer for how the market is doing. So in that S&P, in that index, there's a little piece of all of those 500 stocks that make up that index.
Right. So perfect. And the S&P, if you just took the money from your 401k and put it in an S&P mutual fund, there are funds that invest in the S&P so that you get a piece of all those stocks when you invest in that fund. The S&P over the last 25 years has returned an average of 9%. 9%. Over the last 25 years. Is there up and down years? Sure, you could see that from this chart, but the average return is 9%. That's pretty darn good. As a matter of fact, most people say that, and correct me on this, Chris, 99% of all mutual funds don't beat the S&P return, correct?
Well, yes, but I would qualify that with a little bit of color, but I don't want to get too deep into the weeds. So,
so it's now that's over the long haul. Can a fund do really, really well? Excuse me, can a fund do really, really well and beat the S&P? Sure. But over time, the S&P will actually 9% return. So now let's talk about that 401k. $10, save $2.90, earned 50 cents because your employer matched, and then got another 9 cents every year. The 401k is super powerful. Now, I did Robin a disservice, so we want to slide back real quick. So Robin asked about paying off your house. In the personal budget form, you'll notice we put the house balance right here. I put the minimum payment here. And then I actually showed that a lot of people just round up their mortgage payment. But you know what? That 46 bucks came directly off of principal. And even though this individual didn't put it in their mutual funds or their emergency fund or their 401k, it's still savings because they earned $46 of equity. So we do count that over here in savings. So there is a place for paying down your mortgage, but I want that done after you have your emergency fund squared away, after your credit cards are resolved, and as you're already plugging into your 401k, then you could worry about your mortgage. Get your safety net in your retirement set up first, then you could worry about prepaying your mortgage. So anyway, I wanted to address that in like Tony and I talked about the fact that this is the first time we're presenting it. So the slides will probably readjust some of this, but ultimately I think we got that covered. Okay.
Rich, can I interject for a second? I don't want to mislead anybody about 401k. So keep in mind, if you contribute to a 401k and you come to a point where you retire, and when you are 72, the government says you have to start taking money out of either the 401k or an IRA.
Currently, by the way.
Correct. Well, that's the numbers just got adjusted up. It used to be 70 and a half. It got adjusted up to 72. So, but when you do take that money out, you do have to pay Uncle Sam. So I don't want it to seem like you never pay taxes on this money. You will pay them at a later date.
Sure.
And when you take money out of the 401k or an IRA, you have to pay at ordinary income tax rates. So the assumption is when you retire, you're going to be in a lesser tax bracket than when you're working.
Yeah, so you won't, when you retire, you won't have the income from your job or whatever your job you have when you're in your 60s or 70s. You won't have to, and you could pull money out before that, when's the soonest you could pull money when you're retiring? When's the soonest you can pull money out
So
without
when
paying the
you're
10% penalty?
right, when you're 59 and a half, that's the magic time that you can start taking, and the government always uses weird ages, so there's no rhyme or reason to that, but it's 59 and a half, and you don't have to pay the 10% penalty for withdrawing money early.
Yeah, that's perfect. The bottom line, guys, is, I mean, it's nice to have that problem. When am I going to take money out of your retirement account? I will tell you, from doing applications and helping homeowners for the last 30 years, how many people I see that are in their 40s and 50s that don't have any retirement savings. So, I mean, the fact that you have to pay some taxes on money that you have, it's not the worst thing in the world. It's better to have the money there. So,
Right.
Robin asked the question about, is there any truth to making your mortgage payment every 2 weeks? I think what she's saying is that, will that help knock down your principal? And it will. So if you pay a half of payments every 2 weeks, then you're technically making, there's 26 2-week periods in a month, which ends up making, you'll essentially make 13 mortgage payments in a year. So 13 mortgage payments, you're making an extra payment. Now, the one thing about the half a payment is you have to be very careful how you do it with your mortgage servicer. Not every servicer handles that the right way. You should contact your mortgage servicer if you think you're going to pay a half a payment every 2 weeks. Sometimes what they'll do is they'll just hold the half a payment until you pay the other half, and you're really not accomplishing much. So, because their systems aren't built to take a half a payment. Other companies may charge you a fee to take that half a payment, and they have because they have to, it's more work for them. So they may charge you a one-time $250 or $350 fee to administer that. My simple answer to this is, take a payment. Let's assume your payments, for simple math, is $1,200. Take your payment, divide it by 12, just throw that on your payment. Effectively, you're doing the exact same thing as paying your mortgage payment every 2 weeks. You're getting an extra payment in there a year. One extra payment a year will knock 7 years off your mortgage. You're talking about taking a 30-year mortgage and bringing it down to 23 years. So yeah, it's definitely effective. However, pay down the credit cards, have an emergency account, have a 401k, then worry about your mortgage. So hopefully that answered that for Robin. And let's see here. Okay. So we have Kim actually does some term insurance. So that's good. I didn't know that about you, Kim. So that's good. She's offered some of that. All right. So we talked about 401k. Now, once you have your 401k rolling, the very next thing, and by the way, this wealth accumulation chart, we will begin to teach all of our customers. Can't talk today for some reason. I think too much coffee, but we'll begin to teach all of our customers moving forward. We talked about number one, own your own home. That's the key. Why is owning your own home important? 90% of all millionaires have real estate. So the difference financially, we talk about this in the home buying class that I'm going to teach next weekend, next Saturday, this Saturday coming up. The difference is the average renter has a net worth about $4,700. The average homeowner has a net worth of about $194,000. Night and day difference. You got to own your own home if you're going to be financially independent down the road. Number two, talked about the will. We talked about term insurance. We talked about having 3 to 6 months worth of liquid reserves. We talk about maxing out your 401k. So once you get your 401k rolling, and now you still have some additional savings. And for Robin, she's paying down her mortgage because this makes her happy. But after we do that, we should do some investing. So how do we invest? You seek somebody like Christine and say, hey, look, I'm financially solid, Christine, but I'm ending up with about $300 a month. Can you help me? What do I do with it? So what I suggest and how I've been mentored, and Christine we didn't talk about this, but I'm going to tell you how I do things, and we'll certainly get Christine's opinion. What we do is if I have, let's say, $1,000 left over, we paid all our bills, I got $1,000 left over. I'm going to take $800 and I'm going to send it to Christine and say, hey, invest it the way we've discussed. We've had a conversation where to invest it based on my risk tolerances, my age, and what my expected outcomes are. That remaining $200, I'm investing myself. Why am I investing that myself? Because I want to know about the market. I don't want to just trust everybody. I want to know a little bit more so I can have a better conversation with Christine down the road. Now, what do I invest that $200 in? Well, I can't buy Amazon stock because one share of Amazon stock is close to $3,000 a share. I can go into Robinhood. I could buy a fraction of it. The fact of the matter is, I'm actually going to start learning about where to invest. Do I expect to do really well? I don't know. Could I just put it all in the S&P? Sure. And then I'll watch the S&P and see what it's doing. Warren Buffett is a great recommendation as far as how he buys stocks. He buys stocks in companies he knows. So if you really love Lululemon, you should probably buy some Lululemon stock. If you're Warren Buffett and you go to McDonald's every morning, because he does, he owns McDonald's stock. Do some investing on your own into companies that you know that you like, just so you can learn a little bit about it. Give the rest of the money to the professional. I don't think you'll outdo the professional. Don't throw the $200 into crypto, but learn a little bit about things. By the way, I might take 20 of that $200 and throw it into crypto because it seems like it's here to stay, but I'm not going to take the whole $200. And by the way, Christine's got my other $800 and I already got a 401k. So I got plenty of money. If the 20 bucks goes away, it's not going to kill me. Christine, what are your thoughts?
I actually agree with you. I think that everybody should have a little bit of a hand in the market. I would say you want to play a little bit with some stocks. One of my clients happens to be my husband, and he plays with stocks. And I had an argument with him this morning, and then I left because he was not understanding what I was saying. But for your long-term money, you want to give it to a financial professional like myself. For your play money, knowing that that $200, you might lose it, but you also might, you might double it. Who knows?
Sure.
But it does give you an insight into the market, because I don't expect you to look at what your 401k is doing every day. I wouldn't expect you to look at accounts I'm managing every day, but those 5 stocks or whatever it is, 1, 2, whatever. And again, buy the things you like. When my daughter was in 4th grade, her class did some paper trading. And she goes, Mom, what do I buy? And I go, well, honey, just go into the bathroom and turn over the toothpaste and look at the toilet paper and look at all the stuff in the bathroom. And that's going to tell you what company makes those things. Sure. And then you want to do some research. You don't want to just buy something because, maybe you like their product, but maybe it's not that good. But you want to do some research into the company and what they're doing and what their returns have been and all of that before you buy it. You don't just willy-nilly buy it. But I gave her a little bit of guidance as to what she, you like to shop at Target, you like to shop at Home Depot, those kind of things. So look at what you do as a person and then do some research into what that company is doing.
Yeah, I really, and Target's a great investment, I think. Home Depot and Lowe's certainly have had some really strong returns. And, you could think about, depending on where your head's at, maybe you're investing a little bit into industries you're familiar with because of your job. Maybe you're investing into things that you think will come back because of whatever's going on in the planet. Eventually people will start flying and cruising again, whatever. So you can make some investments that way, but ultimately you should have a little bit of a stake in the game, do a little bit of your own investing, be a little bit knowledgeable on your own money. And interestingly enough, when you start doing this, you'll end up talking to other people. You'll find yourself talking to people who are doing the same thing. So if you're more educated about it, then you're going to be in great shape. If you do these things, we know that you're going to be in great shape long term. This is the stuff that I teach. This is the stuff that I teach to my clients. This is the stuff I teach to our customers or our employees, I should say. And I'm real happy to do it. We're going to be doing, again, this program every month for everybody that we closed in the previous month. Because as I say, we helped you to get into debt. Now let me help you get out of debt. So that being said, any questions? Anybody got some good stock tips for my $200 that I've got? Post those in there. So let me know about that. And yeah, we'd love to hear a little bit of feedback from you guys. Christine, I wanted to thank you for being part of this today. And I know just from the way we've interacted today, when I said that we were on the same page as far as investing. I wasn't kidding. So it's been a pleasure to have you in here as my co-host. So
Thank you. I
uh,
appreciate it.
yeah, it's been good. All right, so it doesn't look like I have any questions. Budgeting class, I know Tony put her email address in there. You could also email me if you want a shot at taking a look at the budgeting class. I think it's a really good class to begin this journey to make sure that you're doing everything right. I got some feedback from Robin. She appreciated the class. Thank you very much, Robin. Let's see, did I miss any questions? I know Kim said that she's in. Kim said that she does sell term insurance, so that's good. If anybody needs Kim's contact information, you could reach out to me. Kim is actually one of my realtors, very successful realtor. Let's see here, who do we got in here? And that's it. I think that's it. I think we covered everything. Thank you guys for attending. Chris, thank you very much for joining us this morning. Tony, thank you very much for making this all possible. I appreciate you more than words can say. Everybody enjoy your weekend, stay safe. And by the way, if you know of anybody looking for great mortgage advice, let them know we're here. Thanks, guys. Bye-bye.